Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, July 15th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. The first chart that we're going to look at is a 9-month weekly candlestick chart of the S&P 500. So each candlestick on this chart does represent 1 week of trading. And what we can see here is for the week, the S&P 500 was down 93 basis points, 0.93%. And we closed at 3863.16. And of course, the candle over here on the right where my cursor is circling is this last week's candlestick. And let's start here with this downtrend line. Now, what's really interesting here, guys, is when I drew this downtrend line and then counted these weeks, what we can see is there's only been 3 positive weeks of trading on the S&P 500. 1, 2, 3 in the last 15 weeks of trading. Okay, I mean, so it just shows you how much weakness has been in this market over the last 15 weeks. But when we look at this horizontal line right here, all right, this is what I call my bear market line. This line is set at 3854.89 on the S&P 500, all right? And that line, that 3854.89 line is 20% below the all-time intraday high. I don't have that annotated, but it's right over here where my cursor is circling, that we hit on January 4th. The peak in the S&P 500 on January 4th, the intraday high, all-time intraday high, 48.1862. Okay, if you subtract 20% from that, you get 3854.89. Well, why is that important? Well, we closed at 3863.16. So technically, we closed by a bear's whisker. I had to have a little fun with it. We closed by a bear's whisker just out of bear market territory, right? So where we closed on Friday, the 15th of July, is just above a bear market. We are not technically in a bear market on the S&P 500, all right? And I want to encourage you to avoid the hyperbolic, immature, the market's going to crash type. Avoid those videos, all right? It's not going to do you any good to watch that kind of stuff, all right? If you want facts, if you want market-based truth, then I'm your guy, and you're probably going to want to subscribe to this channel if you haven't already done so. There's over 10,600 people, thank you very much, that have subscribed to this channel. If you're not one of them, make sure you hit that subscribe button so you can continue to get these videos, all right? Because I give you market-based facts. I don't give you opinion. I don't give you guesswork. I don't give you, politics. I stick to market-based facts based on decades of working in financial services and decades of personal trading and investing, all right? And I've looked at tens of thousands of charts. If you want to avoid the hyperbolic, sensationalized rhetoric that is so prevalent on so many videos these days with respect to the stock market, then stick to my work and I'll show you what's going on in the markets, okay? But you're never going to hear me use, the words like, oh, the market's going to crash. I mean, what does that mean anyway, right? If you can't put a number to it, right? If it's all just emotional clickbait, do yourself a favor and don't fall victim to that, all right? I don't think you ask any of those the market's going to crash guys to quantify what they mean by a market crash, and they can't do it, all right? So with that said, let's move on, all right? But we know that we closed by a bear's whisker just above the bear market line here. So technically, the S&P 500 right now is in a correction, not in a bear market. And now let's move on to a shorter term chart of the S&P 500, get a little bit more granular and do what I call put the market under the microscope. So what we're looking at here is a 60-minute chart of the S&P 500. So each candlestick on this chart does represent 60 minutes of trading. This is a 2-month chart. Several horizontal blue lines here, 39.80, 39.50, this one here. We also have the bear market line, right, which we just saw on the other chart, on the weekly chart, 38.54.89. That's this top line here, and then 38.30, this line right here. All right. So we'll spend just a couple minutes on each one of these areas, but let's start with the 39.50 level, because of all these, this has probably been the most important level to watch on these shorter term charts over the last couple of months. What we can see here is we have not had any trading above 39.50 on the S&P 500 since this 1 hourly candle on June 10th. All right, so for just a short period of time on June 10th, this first opening hour on June 10th, we traded above 39.50. But since that candle right here, there hasn't been any trading above this 39.50 level. Right, we came close a couple of times, but we haven't been able to get above that. And we know that once we broke below this, right, then we fell down and hit our lows so far of this downturn intraday on June 17th at 36.3687. So right now, 36.36.87 on June 17th intraday. That has been the lows so far of this downturn on the S&P 500. And since that low on June 17th intraday, we have been in somewhat of an uptrend. Now, we broke below this 38.30 line again, and I'll kind of go back and backtrack on this here in a second, but we had some trading below the 38.30 level, especially on the 13th and 14th, so Wednesday and Thursday of last week. But Friday, as you guys know, right, monster rally at 1.92% alone on Friday, even though Friday, as we know, right, we were down 93 basis points for the week, but that includes a 1.92%, I'm just circling it up here in the chart, I don't have it annotated, but 1.92% up day on Friday. And that up day on Friday brought us right back up to that bear market line. And as you can see, it's kind of hard to see. Hopefully you're looking at this on a larger screen, but the very last hour of trading on Friday the 15th was the candle that brought us back above that bear market territory. All right, so we had definitely been in that bear market territory up until the last hour of trading, and we just squeaked barely above it. All right, so I want to be fair. I mean, we're barely out of the woods here, right? 38.63.16, where a bear market is 38.54.89. But again, guys, please do yourself a favor and be honest with yourself. Suppress the human emotions. Human emotions are the worst thing when it comes to trading and investing. They will hurt you, not help you. So it does you no good. It hurts you if you're using sensationalized language, immature language. You're using hyperbolic rhetoric to talk about the stock market, guys. Please, for your own benefit, do not do that. All right? Deal with the facts, and whatever they are, they are. Be agnostic when it comes to the facts. You don't care what the truth is. You just want to know the truth, okay? And the truth is, right now, we are trading just above bear market territory, but anything below 38.54.89 puts the S&P 500 in a bear market, okay? So based on Friday's trading, we kind of jumped back out of this area, and we still technically have this short-term counter-trend rally intact after taking a couple of days off on Wednesday and Thursday of last week. All right, so hopefully this is all making sense. Now let's back up here and kind of take a look at some things here. So this 38.30 line, you can see back here in May, okay, we pulled down on the S&P 500 to this 38.30 line, but no hourly candles closed below that. All right, so this 38.30 line from that point became a support and resistance area, and you can see that it came into play at the latter part of June and first part of July there, where we pulled up to that 38.30 line but couldn't get above it. All right, and then even last week, right, we had some trading right up to 38.30, got rejected, fell further, and then finally got back up above it, and then back up to this bear market line. Now, and you can see there's been some trading right around that bear market line, but that's not really why I have that. I don't have it in there from a support and resistance standpoint. It's just so you know exactly where the bear market is. The 39.50 level, right, now that is acting as overhead resistance. So, and has been since as we know, since June 10th. Well, if the market is going to continue to rally over the next couple of weeks, At some point, we're going to contend with this 39.50 level. That's if the market continues to, to go higher and doesn't roll over. Okay, so this 39.50 level will be a very, very important level to watch. And if the market is going to continue to push higher throughout the month of July for the next couple of weeks, of course, then we will need to get above this 39.50 level and then back up above 39.80. And you can see 39.80 in May, right? Acted as overhead resistance right here, and then we had a small amount of trading for about 2 weeks above 39.80 and got clear up to right around 41.80 right here for a very short period of time, and then obviously on July 9th, that was the last trading above 39.80, and then we fell down and of course hit those lows. So kind of gives you a quick recap here on a shorter term chart, putting the market under the microscope. So obviously keep an eye on the bear market area, 38.54.89. Anything below that, we are technically in a bear market. Anything above that, we are technically in a correction, not a bear market on the S&P 500. 39.50, super important short-term overhead resistance point. If we can't get above that, guys, not good. And of course, if we see the market roll back over and start to trade below 38.30, we know that we've ran into a problem. And then that next area to watch is right around this 36 level. And if that doesn't hold, then of course we're going to take another leg lower on the S&P 500. Are you a business owner or a busy executive, including a doctor, dentist, attorney, or realtor? Do you manage any of your own money, including in your 401k or IRA? Are time and money important to you? If time and money are important to you, then simple market signals should be important to you as well. Simple market signals is for business owners, busy corporate executives, and other professionals who want to cut through the stock market BS and get down to the facts. If you value your time, if you value your money, you need simple market signals. Simple market signals is based on a proprietary formula developed by a former financial services professional with decades of real-world experience. Simple market signals is equity investing information simplified. Simple market signals saves you time and helps you understand market trends and risk management in a way few enjoy. Just try it. There's no contracts. You can cancel anytime, and a subscription to this information is less than 67 cents per day, and it's priced way less than it should be for the value it brings. To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. So again, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com.